Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video, I'm going to continue with the S&P 500, looking at the S&P 500 sectors. So we have done quite a few videos in terms of consumer discretionary, consumer defensive, consumer staples if you like. We've done one for technology, we've done one for healthcare, we've done one for financials, and now we need to do a couple of more. So I think we've done one for materials, and now we're doing energy today. Okay, and energy is some of the sectors that some of you have asked me to look at recently. So what we want to do today in today's video is just to look at 5 different companies in the energy sector. Energy has outperformed the S&P 500 2 years in a row. So 2021 it actually it outperformed the S&P 500, all the other sectors. Okay, and it returned it basically went up 55% that year. And this year, just last year, 2022, it went up almost 67%. So it has definitely outperformed the S&P 500. And this is not the first time this is done this, okay? But in the last few years, especially in 2020, remember when the the oil prices actually went to zero? That's when was the right time to buy these companies. But we want to see now if some of these companies are actually still a buy, and what the overall sentiment is when it comes to this. And if you look at the companies like Bloomberg, for example, they're saying, in fact, Wall Street sees energy stocks beating market for 3rd year in a row. So that will be interesting. So what we want to do is we want to just make sure that there basically are the companies that are in there, are they quality? Are they good buying to basically right now to add to our portfolios? Or have they gone up so much that they are now overvalued? So that's what we want to do today. Just check these 5 different companies. And the first one that we are looking at is Exxon Mobil. This is one of the oldest oil companies out there. It used to be Standard Oil, like back in the days when Rockefeller was actually the owner of Standard Oil. This company explores for and produces crude oil and natural gas. Okay, it has a market cap of $439 billion. Okay, it has a current price is $106 per share. I remember seeing when this was about $40-50 per share, around the time oil prices were absolutely in the negative. Okay, dividend yield of 3.41, 5-year growth rate of just 3%, payout ratio very, very low, 28%, which is nice. It has increased its dividend for 39 years in a row, annual payout. So this is what they will pay you for owning a share of this company, and that's $3.64. The safety is actually 80%, so that is really good. Above 61% is actually quite good. Profit margin is decent, okay, 13.4. Return on equity almost 30%, and free cash flow of $59 billion. Now, one thing you need to remember, these companies do need to have a lot of cash in hand because they burn a lot of cash. Okay, they get into all sorts of problems and then they have to pay them out and all of that stuff. So they need a lot of cash in hand. Okay, total return in the last 10 years, you're just looking about 4.5%. And this is probably one of the reasons why a lot of people do not invest, okay, in these oil companies, because the return is not great. They do have some good dividends, and it's good to have them, in my opinion anyway, in any portfolio, because they are, obviously, if you're looking at the S&P 500, imagine if you owned the energy stocks this year, okay, and you had some technology companies that were down so much. So tech companies, for example, okay, let me find technology companies. The S&P 500 was down, so let's call it 18-19%. Okay, utilities just 1%, consumer, and then healthcare. And when you look at real estate and information technology, was down about 28%. So it will balance things. Okay, so that's one of the reasons why we should always have a balanced portfolio and have a different sectors basically represented in your portfolio. And as you can see, next year they're expecting about 19% minus 19% growth, which is not basically great at all. But the following 5 years, we're expecting about 25% premium. Now, this is the reason why this next year things will come back down, because the demand for oil might not be as much as it was in 2022, right? But then after that is going to stabilize, probably grow again 25%. Again, remember, this comes from the analyst, so you're going to have to do your own research and find out a bit more if you're interested in these companies. Right now, 4% premium, okay, basically $2 per share is where it should be. Right now we're looking at $106, okay, so kind of fairly valued right now. And just to show you, a year ago this company, okay, was basically trading about $60, and right now it's basically went up 60% from that moment, okay, a year from a year ago, which is quite a lot if you think about it. So the next company is Chevron. Okay, so Chevron does exactly the same. It explores for and produces crude oil and natural gas. $336 billion. Up until very recently, I actually thought Chevron was bigger than Exxon, but Exxon is way bigger. $336 billion, $172 per share right now. I do remember when this was about $80 per share. And at the time I was like, should I buy it? Should I not? And I never touched it. Okay, but right now look at it. Basically we're looking at 3.3% dividend yield, 5-year growth rate just 4%, payout ratio quite low, 32%, 34 years of paying that dividend. Annually they will give you $5.68 for every dollar, for every share of that company that you own. 90% in dividend safety, which is one of the highest. Okay, 99 is the highest and 90 is absolutely perfect. Profit margin. So what this tells us basically is that they're not going to cut the dividend anytime soon. So if you're buying this company for the dividends, then you are safe. You don't have to worry about it. You can collect your dollars every single month, and they will increase it because these companies take pride in terms of increasing that dividend. They're dividend aristocrats, so they don't want to lose that. Profit margin about 15%, return on equity almost 23%. Free cash flow of $35.8 billion, total return 7.2. So this company is actually done better than Exxon. Exxon have had a lot of issues over the years. That's probably one of the reasons, okay. And the next year they're expecting about 13% growth, but then after that 15% every single year, 17% premium right now, $149 per share. Let's compare the two. So let's add CVX in there. Okay, and as you can see, they kind of mirrored. Actually, they are kind of done the same thing. So Chevron's gone about 40%, Exxon is actually gone up about 60%. Okay, so those are the first two companies. Right, so we've got 3 more to go. So the next one is EOG Resources. This company explores and produces and the markets as well, crude oil, natural gases, and natural gas liquids as well. $73 billion market cap, 124 dollars in basically price wise, and 2.65 dividend yield, which is quite good, and 24% growth in the last 5 years, which is absolutely amazing. Payout ratio 22%, dividend streak of 4 years, increasing that for 4 years. $3.30 is what they will pay you. 82% dividend safety, profit margin of 30%, return on equity of 33%. On free cash flow, we're looking at $6 billion in right now, and almost a 9% total return in the last 10 years. And the next year they're expecting about 7% growth. Okay, so this is actually has a positive growth next year, and then after that 11% premium right now, $112 per share is where it should be. So it just needs to come down maybe another 10% or so to actually look into this. So let's add this one, actually EOG, see where it is at right now, so we can compare. Nope, that's not the one. That's not what I wanted to do. I want to compare it. So here we go. Add one more. And as you can see, actually not bad, 32%. So very close. Okay. Very, very close. So the next one is Chronicle Phillips. This company actually produces, transports, and markets crude oil, okay, natural gases, liquefied natural gases, and natural gas liquids worldwide. $141 billion company, $113 per share, and just about 5% dividend growth, 5% dividend yield almost, okay. And then in terms of growth, last 5 years, we're looking at about 12%, payout ratio 23%, 5 years of increasing that dividend, $2. Okay, that's what you get for holding that their shares. 61% dividend safety, so that's on the safe line. If you think about anything below that, it becomes a bit dangerous. Profit margin 24%, 37% return on equity. Free cash flow over $18 billion. Total return, we're looking at about 9%. Next year, about minus 10% growth. And then next 5 years, about 25%. 18% premium, $96 per share. Let's add this one as well and see where we're at. So COB. Almost 50%. Wow. These companies have done absolutely amazing last year. All of them. Right, so the last one is Dividend Energy Corporations. This is an independent energy company. And basically, they engage in the exploration, development, and production of oil and natural gases and natural gas liquids in the United States. $38 billion market cap, $58 per share right now. About 9% dividend yield, which is very, very high. And then 5-year growth rate of 36%. Payout ratio 58. Okay, dividend yield, just a dividend streak 4 years. They pay you $5 for every share that you own. And safety is 41. That makes sense, right? Because look at what they're paying. Just almost 9%. That's huge. 4%, basically 41%. Okay, profit margin is really good. Its return on equity is absolutely amazing. $3.4 billion in market cap. But they are very small companies. So $38 billion, they have $3 billion, $3.4 billion in the bank. Total return last 10 years, about 2.75. That's probably a lot of it to do with the dividends. So you probably make your money through your dividends more than anything else. Next year, about 2%. Next 5 years, they're expecting about 31% growth, which is actually quite really high. Okay, and then basically 29% premium right now, $45 per share is where it should be. Right now, it's actually way lower than that. So Dividend, let's add that one as well, and then see how it did. Okay. Every single one of these, what we're looking at right now is a year to date, by the way, okay? And you can see every single one of these companies has actually would have given you 28% or more in terms of price appreciation last year if you owned them. Now, does that mean we should expect the same thing? I don't know, okay? According to these guys here, they are expecting it to do more or less the same. However, I don't think it will be as good as what we see here. Okay, I don't think it will be. And it wouldn't hurt for a portfolio of, say, 30 to 40 stocks to have at least a minimum of one company or two companies from the oil company, or maybe have 2-3%. Because remember, energy always used to be, before last year, it used to be about 2-3% of the total S&P 500. So if you have the same kind of allocation, then you actually shouldn't have any problems. But then again, the risk with these companies is going forward, they have so much risk. So sometimes there's oil spill and they end up basically getting into all sorts of trouble, okay? And the fact that they're not really helping the environment and so on, a lot of these companies have come out, especially Chevron is actually diversified and EOG is actually quite good. But Exxon is still under fire for basically what they're doing to the environment and so on. So the environmentalists is actually fighting these companies a lot. And for that reason, not many people like them. That's why people prefer the Teslas, if you like. But I don't think these companies will go out of business anytime soon, at least for the next 10 to 30 years. I promise you, they're not going to go away. We will have the energy, we will have all the EV cars and all of those things, but I don't think we can easily diversify away from oil in the next 10 to something years. That's just my opinion, okay? And like I've always said to you guys, I'm trying to be transparent as much as I can. The two companies I actually like from this list is, in fact, I like all three of them. But this one has got so many other things going on in their business. I'm not sure until they clean up their balance sheet and be transparent in terms of what they want to do with the future. These two, I think, probably you might see them in my portfolio if they come down a bit. But right now, they are too expensive. I'm not touching them. I'm not adding to the portfolio anytime soon. Financially, these two actually seem to be very good in terms of Chevron and EOG Resources. So I'll let you know how it goes, inshallah. That is my take on these companies. The portfolio is still doing all right. Okay, it's still going up. Okay, I've added money this week. You saw me buy actually a couple of days ago, and I will be adding more. So right now, what are we on? So I still need to add £7,000 before April the 7th. So yeah, inshallah, we'll see how that goes. Have a wonderful day. Assalamu alaikum.